The stock market doesn't set the price of a business. It just shows you what someone is willing to pay today. Those are two very different things, and billionaires exploit the gap. A share trading at 800 Rand isn't necessarily worth 800 Rand. Intrinsic value is the real price, calculated from actual earnings, assets, and growth. When these two numbers diverge, that's where the money is made. So, intrinsic value is what a stock is fundamentally worth based on its business performance, assets, and future earnings. That's regardless of what the current market price is. Imagine a stock that makes 100,000 Rand profit per year. A fair buyer might value it at 10x earnings, that's 1 million Rand. If someone is selling it for 600,000 Rand, there's a gap. That gap is your opportunity. Intrinsic value is the 1 million Rand. The market price is the 600,000 Rand. Warren Buffett's entire 60-year career is built on one idea. The stock market frequently prices companies incorrectly in the short term, sometimes too high, driven by hype, FOMO, and speculation, sometimes too low, driven by fear, bad headlines, or temporary problems. Intrinsic value is your anchor. It's what you calculate the company's actually worth based on fundamentals. That's its earnings, growth rate, assets, and competitive position. The gap between intrinsic value and market price is what value investors call a margin of safety. If you believe a company is worth 100,000 Rand per share, but you can buy it at 60 Rand, you have a 40 Rand cushion. Even if you're slightly wrong in your calculation, you still do well. Everyone calculates intrinsic value slightly differently. That's what makes markets work. One investor sees a company as worth 80 Rand, another sees 120 Rand. The disagreement creates buyers and sellers. When your estimate is right and the market eventually agrees, that's when you profit. So why does all this matter? Firstly, this is the foundation of value investing. All the greatest investors like Buffett, Munger, Lynch use intrinsic value as their North Star for every buying decision. Secondly, it creates your margin of safety. Buying significantly below intrinsic value means you can be wrong by a fair margin and still make money. It's built-in protection. Here's Benjamin Graham's famous formula. It's not perfect, but it gives you a quick sanity check before buying any stock.